Before we start this video, do like and subscribe to our channel and not miss on any updates.
So now, AS20 again, there are few these are some of the standards that I have told in the beginning also, where there are specified set of questions. 90% of the questions are similar in nature, which are tested in the examination. AS20 is one such standard. If at all a question comes, you should not be scared. You should actually be solving for whatever steps you do or for whatever steps you solve. You will get stepwise marking, so you don't need to worry, right? Now, when we talk about AS20, that is earnings per share, what this standard requires us to do, and this is a disclosure standard, okay? There is no accounting entries done. So AS20, AS18, segment reporting, all of these are disclosure related standards where there is nothing talked about passing journal entries or recognizing some items in the financial statements. Now, when we say EPS, which is earnings per share, the standard requires us to calculate earnings. Now, when we say earnings, what is this? This is profit attributable to equity shareholders. We are talking about for every equity shareholder, how much is the company earning per year or per quarter. So it is always on a per share basis, and it is earnings attributable to equity shareholders. Two formulas you need to remember. When we come to diluted, we'll talk about diluted separately. So when we say earnings per share, the standard talks about calculating basic earnings per share and diluted earnings per share. Basic earnings per share and diluted earnings per share. When we say basic earnings per share, this is standard, this is normal for all the companies where it is applicable. It says what is the earnings available to equity shareholders divided by weighted average number of equity shares. Weighted average number of equity shares. So we need to know two things. Numerator is earnings available to equity shareholders. Denominator is weighted average number of equity shares outstanding. Now, what is this earnings available to equity shareholders? We will start at net profit after tax. If it is given as net profit before tax, you have to calculate net profit after tax minus dividend payable to equity shareholders. Net profit after tax minus dividend payable, sorry, not equity, my bad, preference shareholders. So what is the net profit after tax? Let us say it is 10,000. Out of this 10,000, we have to pay, let us say, 4,000 to preference shareholders as dividend. So this 6,000 is what is called as earnings available to equity shareholders. Now, when it comes to preference shareholders, there are two categories of preference shareholders. One, we say cumulative. Second one, non-cumulative. In cumulative preference shares, dividends accumulate even if not paid. In case of non-cumulatives, dividends do not accumulate. Dividends do not accumulate, right? So, cumulative dividends accumulate even if it is not paid. So, for example, the company has not declared dividend, but in the future, for the past years, you have to pay. That is what is called cumulative. For example, year 1, year 2, year 3. Year 1, for equity shareholders, no dividend was paid. For preference shareholders also, no dividend was paid. In year 2, no dividend was paid. In year 3, the company wants to pay dividend to equity shareholders. So, first it has to pay to preference shareholders dividend. Now, if it is cumulative, you have to pay the dividends for year 1, year 2, year 3. So you will get dividends for all the 3 years. If it is non-cumulative, you will get dividend only for year 3. year 1 and year 2 are gone. Now how is it relevant? It is relevant because this dividend payable to preference shareholders, if the preference shares are cumulative in nature, then whether or not paid, please remember this line, whether or not paid, you have to deduct, meaning to say for cumulative, you will always deduct. Sir, why will we always deduct? We will always deduct because it has to be paid in the future. Whenever you pay to the equity shareholders, you have to pay. So you will always deduct this dividend attributable to cumulative preference shares. If it is non-cumulative, then deduct only when declared. Deduct only when declared. So things what you have understood, you will take net profit before tax, you will reduce the preference dividend. For cumulative, always. For non-cumulative, when declared. Now what is the rate to be taken? They will tell us it is 10% cumulative preference shares. So at 10% you have to provide. Okay, so that takes care of our net profit after tax minus dividend paid. We get earnings available to equity shareholders. Then the second component is weighted average number of equity shares. Weighted average number of equity shares. Now what is the meaning of this? Generally what happens is, if you take a timeline, this is the first day of the first month, this is the last month. Okay, here let us say 10,000 shares are outstanding. Somewhere here on 1st of July, the company issued 5,000 shares. Company issued 5,000 shares, right? So on 31st or in December, total shares you have is 15,000. Now, whatever earnings we have made is for the full year. Whatever earnings we have made is for the full year. But closing balance of shares is 15,000. If I divide the full profit, let us say 1 lakh profit. When I am saying profit, this is earnings available to equity shareholders. If I divide entire 1 lakh by 15,000, it does not give me a true picture because 5,000 shares came in between. So to these 5,000 shares, I cannot attribute full year's profit. That is why we need to do calculation of weighted average number of shares. How to calculate? There are two ways. You can use whichever way you are comfortable with. First method is first of January of, let us say 25. Number of shares 10,000. These 10,000 shares are outstanding for 12 months. For full 12 months, 10,000 shares are outstanding. So when you calculate weighted average, you will take 10,000 multiplied by 12 divided by 12, you get 10,000. Then on 1st of July of 25, you have issued 5,000 shares. 5,000 shares. These 5,000 shares are outstanding only for 6 months period. Only for 6 months period. So you will give the weight as 6 months out of 12. So basically what we are saying is, if I have 5,000 shares on 1st of July, it is as good as 2,500 shares for the full year. So this will be 2,500. The total becomes 12,500. This is the first method. Second method is using the cumulative basis. That is, 1st of January of 25, we had 10,000 shares. When did the next change happen? Next change happened on 1st of July. Next change happened on 1st of July. So what you will say, this is outstanding for 6 months. So weighted average number is 10,000 into 6 divided by 12. This is 5,000. Then on 1st of July of 25, this is cumulative. Cumulative shares became 15,000. Here, cumulative shares became 10,000 plus 5,000, 15,000. This 15,000 is outstanding for the next 6 months. This is outstanding for 6 months. So, you take 6 months for this. 15,000 into 6 divided by 12, you get 7,500. Total is 12,500. Are we clear with both these methods? of calculating weighted average number of equity shares? Others, are we clear? Okay, great. Right? Now, when we calculate EPS, EPS is earnings available to equity shareholder divided by weighted average number of equity shares. So what is earnings available? Here we have assumed it is 1 lakh. So it will be 1 lakh divided by 12,500. This will be 12 8s are 96, 4, 5, 8. So this will be 8 per share. So EPS is equal to 8 per share. Okay, this is the basic. Now at least till here, basic earnings per share, whatever type of question comes, you should be able to do comfortably. Now one more angle, if there is buyback, sometimes what happens is there is a buyback of shares. Whenever there is a buyback of shares, you will treat it as a negative number. Let us say minus 1000. You just take it as negative number and do the calculation. Okay. Now let us look at some theoretical aspects. So we have understood basic earnings per share. It is calculated as earnings available for equity shareholder and weighted number of equity shares outstanding during the period. Net profit after tax minus preference dividend. If there is a loss, then what happens? Let us say 500 is the loss, minus 2500 is the dividend. So it will be minus 7500. You are basically reducing. Okay. Now, this is where, which is important for calculating date or number of months. Okay, this part is very, very important, where there is sometimes a bonus issue, there is sometimes a rights issue, splits. How do we handle each of them? If equity shares are issued in exchange for cash, they are included from the date when cash is receivable. Now the meaning of that they are included is basically, if I issue shares on 1st of July, from 1st of July I'll count the number of months. I'll count the number of months from 1st of July. So if equity shares are issued in exchange for cash, then when cash is receivable. If equity shares are issued as a result of conversion of debt instrument to equity shares, then date of conversion is relevant. Now what does this mean? This basically means that if I have convertible debentures, one fine day the holders of convertible debentures, they converted them into equity shares. So from the date of conversion, I will consider number of months for calculation of weighted average number of equity shares outstanding. Then equity shares issued in lieu of interest or principal on other financial instruments, they are included as of the date interest ceases to accrue. Meaning to say, if I give equity shares instead of interest, I have taken loan from the bank, I have to pay bank interest and principal. Okay. From the date on which the bank says I will no longer charge interest because I have received equity shares from you, from that date you will consider in weighted average calculation. Then equity shares issued in exchange for settlement of a liability of the enterprise are included as of the date the settlement becomes effective. If I have to pay a creditor, okay, if I have to pay a creditor, I don't have money, I give my shares. So from that date it becomes effective, or from that date you will include in the calculation. Equity shares issued as consideration for acquisition of an asset other than cash are included as of the date on which acquisition is recognized. If I issue shares to acquire property, plant and equipment, from the date on which I have made that acquisition of property, plant and equipment, the date I recognize the entry in the books, that is the date from which I will consider. Equity shares issued for rendering of services are included as the services are rendered. So if I'm taking some services and I'm issuing equity shares, as and when I get the service, as and when I recognize the expense, from that date I will include the equity shares for calculation. Then equity shares issued as consideration in an amalgamation in the nature of purchase are included as of the date of acquisition. So on the date I have made the acquisition, from that date I will consider. Equity shares in the nature of merger are included from the beginning of the reporting period. Generally not tested, but if it is in the nature of merger, you will assume in the pooling of interest method right from the beginning. Partly paid up shares are treated as fraction of an equity shares to the extent they are entitled to participate in dividend. Now what does this mean? Say for example, I have shares with face value 10, and out of these there are some shares which are paid up to the extent of 7 only. Some are fully paid up. Some are fully paid up, some are partly paid up. Whenever there is a partly paid up share, so 7 means what? 70% paid up. So you will consider only 70% for the calculation of weights. Contingently issuable shares, which are issuable on satisfaction of certain conditions, are included from the date when the conditions are satisfied. If there is a contingently issuable shares, for example, I have acquired a business and I have told them that if your business makes profit of so much amount, then I will issue you more shares. The date when the conditions are satisfied, on that date I become liable to issue the shares. From that date I will consider for calculation of weighted average number of shares. Now here what you need to understand is these are generally not independently tested nowadays because of MCQ. They may ask, but generally there is not much of testing directly on these concepts, but you need to remember what is the date from which I should consider. A quick revision, important ones: issued for cash, date when the cash is receivable; for convertible bonds or convertible debentures, date of conversion; when I am issuing in lieu of interest or principal, date when the interest stops; for settlement of liability, date of settlement; consideration for acquisition of an asset, date when the acquisition is recognized; amalgamation in the nature of merger, date of acquisition, purchase, date of acquisition; merger, beginning of reporting period; partly paid up, will take only proportionate. Then the next thing is bonus issue. Next thing is bonus issue. Now what is this bonus issue? You issue shares for no consideration. So basically there is no money that has come into the business. There is no fresh money that has come into the business. Same also applies with split. So if my profit is 10,000 in year 1, profit in year 2 is also 10,000, number of shares 5,000, after bonus number of shares 10,000. If I calculate EPS, here I will get 2, here I will get 1. But this is not a right presentation because shareholders have not changed, new money has not been received, just have increased the number of shares. So what the standard says is, whenever there is a bonus issue, you will treat it as if it was done at beginning of the period and restate previous year EPS as well. Meaning to say, whenever there is a bonus issue or bonus, split of shares, you will assume that it has happened at the beginning of the period, and hence you will consider it full year outstanding for calculation of weighted average number of shares. And also the previous year EPS, which is 2, that also has to be restated. How will we restate that? Now here bonus is 1:1. Bonus is 1:1. That is, if original shares is 1, total new shares will be 2. That is, original 1 plus newly issued 2. So you will do 1/2. So here you will do 2 multiplied by 1/2 and you will put out the factor. Okay. This is 1:1. Sometimes it can be 1:4. 1:4 means 1 share for 4 issued. 1 share for 4 issued means for every 4 share I will give 1 more share. So then the multiplication factor will be 1:4 means old shares are 4, new shares are 5. So 4 divided by 4 plus 1, we will multiply it by 4 by 5. Okay, that is how you will do. Bonus issue, assume that they had occurred at the beginning of the reporting period, also split, and you will also impact the calculation of EPS of previous period retrospectively. Now, before moving on to rights issue, let us have a look at a couple of basic questions and then we will continue. In April 2010, A Limited issued 18 lakhs equity shares of 10 each. Rupees 5 per share was called up on that date, which was paid by all the shareholders. Remaining 5 was called up on 1st of September. All the shareholders except one having 3,60,000 shares paid the sum in September 10. The net profit for the year is 33 lakhs after dividend on preference shares and dividend distribution tax of 6.6. Compute the basic EPS for the year ended 31st March of 2011 as per accounting standard 20. Right. Now first what you have to do, we have to calculate the weighted average number of equity shares outstanding. Now first thing, whatever is opening balance 18 lakhs from 1st of April 18 lakhs, right? Now here what you need to understand is on this 18 lakh shares till 1st of September amount paid is only 5. Amount paid is only 5. So if I draw a timeline, please pay attention. If I draw a timeline, April, September, March. From April to September, number of shares outstanding is 18 lakhs, but this is only 5 paid. That means we have received only 50%. So what you will do, you will apply the weightage 5 by 10 when you calculate weighted average number of shares outstanding. Okay. Now, sir, can we say 18 lakhs was outstanding for the full period and can we take the full amount? No, that calculation will not work. Here you have to see how many shares are there and to what extent it is outstanding and what is paid up. So, 18 lakhs, amount paid is 5 per share. So, 18 lakhs multiplied by 5 by 10. This 5 by 10 represents 50% paid up into 5 by 12. Why into 5 by 12? April, May, June, July, August. Now, very careful. Just because they have given 1st of September, sometimes what students do is April, May, June, July, August, September, they'll take 6 months. Please be careful in counting. We cannot make counting mistakes in the examination. Okay. So, 5 months, 5 by 12. So, 18 lakhs into 5 by 10 into 5 by 12, we have 3 lakhs 75,000. Right? Then, what happened? On the same 18 lakh shares, we got 5 more rupee. But we did not get from everyone. We got from only how much? We got from 14 lakh 40. Basically, 18 lakhs minus 3 lakhs 60,000. We got 14 lakh 40,000. This is the money we have received. So 14 lakh 40,000 paid us full amount of 10. And this part is outstanding for 7 months. So 1440 into 7 by 12, 8 lakh 40,000. Then on 1st of September, the balance 360 if you consider, only 5 was received. So here we will apply 5 by 10 into 7 by 12. Like this you will calculate the weighted average. Now other way to calculate the weighted average is split into 2 parts. 14 lakh 40,000 is one part. 3 lakhs 60,000 is the other part. 14 lakh 40,000 is the first part. 3 lakhs 60,000 is the other part. Now on this 14 lakh 40,000, what can we say? For the first 5 months, again the calculation will be same only. For the first 5 months, you will do two parts. 5 by 10 into 5 by 12. For the second part, 10 by 10 into 7 by 12. And for this 360, we can take 5 into 12 by 12. Okay. So what happens is 1440 into 5 by 10 into 5 by 12. Then this is the second part, and 360 only 5 is paid for the full year. So that also is an approach which you can consider. Now after calculating this, the total comes to 13 lakh 20,000. Then earnings available to net profit for the year after dividend on preference shares and dividend distribution tax. So they have directly told us profit after dividend. This means this is my earnings available to equity shareholder. So what will I do? 33 lakhs divided by 13 lakh 20,000. The number comes to 2.5 per share. Okay, simple question. Again, 4 marks or 5 marks, easily scoreable. And also now institute what they have done in September, and what I think they will continuously do is they will ask you MCQs where you have to calculate only the weighted average number of shares. Okay, so that thing you can keep in mind. This you can practice on your own. I've already done this. Only thing is when there is a buyback, but here buyback has happened on 31st of March. So when it has happened on 31st of March, there is no impact of that. Otherwise, you will treat it as a negative number. Just give me a moment. We'll pick up the compiler also. Both these files are available, the notes also and the compiler also. Both of this is available in the resources section. And if you have not joined the WhatsApp group, please join the WhatsApp group. The link is also given in the dashboard. Okay, under my courses you will get the link. Okay, let's see this. Oh, this is a rights. We will do it after rights. So this is just now what we did, right? Okay. So what we'll do is we'll do the rights one first, and then we'll come to more questions. Okay. Now, rights issue is the issue of shares when the shares are issued to the existing shareholders, generally at less than market price. Now understand the logic, understand this underlying logic, why we calculate it differently. We are saying it is issued at less than market price. So if market price, for example, is 100, I may issue at 80. I may issue at 80. Now what I am saying is the market price is 100, I am issuing it at 80 means I am giving some shares for free. I am giving some shares for free. So there is definitely a bonus element in rights issue. Meaning to say, if I had gone to the market, and if I had issued the shares, I could have issued at 100. But to my existing shareholders, I am collecting only 80. Now, if I am collecting only 80, I am giving some shares notionally for free. For example, if let us say 5 shares are issued in rights, so amount collected is how much? 80 multiplied by 5, that is 400. If I had gone to the market against 400, I would have given only 4 shares. So technically I am giving 1 share for free. So that is why there is a bonus element in the rights issue, and that we will do a full year adjustment. I'll not get into the depth logic of this because that is not our objective, right? What we'll do is we'll see step by step what is the approach to solve questions involving rights issue. First thing, whenever there is a right issue, you have to calculate something called as theoretical X rights price. Now what is the meaning of this? There is something called as come right price. Means this is the price before the rights issue. So when I say come right price, it means cumulative or including the right entitlement. Okay. They'll give us cumulative right price. Let us say this is 100. This is 100. Rights issue is 1:5. Meaning to say, I will get one right for 5 shares. I will get one right for 5 shares. So, if you see my total investment, if I have to subscribe to this, right, I can buy shares at 100. How many shares do I need? I need 5 shares for one right. So, I have to buy 5 shares from the market. 100 multiplied by 5. This is my investment for original shares. Plus, I have to pay for one right share. Let us say, rights price is 80. For one right share, I have to pay 80. 180 multiplied by 1. And now I have a total of 6 shares. This is 5 plus 1. This is 5 plus 1. So, 100 multiplied by 5, this is my original investment. 80 plus 1, this is my new investment. Divided by original shares plus new shares, what I'll get? 500 plus 80 divided by 6, which is 580 divided by 6. That is 6 7s are 56, 2 6 3s are 18 to 73.33. 580 divided by 6, no, not 70, 6 9, 9s are 54, 40, 6 6 are 36, 96.66. 96.66. This is called theoretical X rights price. Meaning to say, in theory, after the right entitlement gets over or after the rights issue get over, then the price will be in the market, the price should come down to 96.66. It should come down to 96.66. I started at 100, I subscribe to new shares at 80, my theoretical X right price becomes 96.66. This is the first step when it comes to rights issue. This is the first step when it comes to rights issue. Okay. Now, in the examination, you can use the formula, or if you get confused with the formula, just see what is my existing investment plus new investment divided by total shares. Existing investment plus new investment divided by total shares. Are we clear? Theoretical X right price is fair value per shares prior to the exercise of right plus proceeds divided by number of shares outstanding plus number of right shares. Or you can say current market price into N plus rights issue into 1 divided by N plus 1. Multiple ways to derive. Okay. What you have to do is use the method that you are comfortable with. Okay. Now, as I told you that there is a bonus element. There is a bonus element in a rights issue which is given by fair value per share prior to exercise of right divided by theoretical X right price. Fair value per share prior to right divided by theoretical X right price. This will be the right adjustment factor. You will multiply the number of shares by this right adjustment factor to arrive at the total number of shares before the rights issue. That is basically, when you do this, fair value per share was 100. After that, it became 93. So, I am increasing the number of shares. Basically, what I am doing is, I am adjusting for the bonus element by using this formula. Okay. Now, we'll take one question, and once we do that question, you will have more comfort in this. Okay. Here, Sapphire, again, see, 5 marks question. Okay. Sapphire Limited earned net profit of 39 lakhs and rupees 59 lakhs 40,000 for 21, 22, 22, 23 respectively. Okay. The following information were given for 22, 23. Company declared rights issue of 2 new shares for each 5 outstanding share. 2:5. Now here, while doing the calculation, we will consider 2, not 1. 4 lakh shares were outstanding prior to the rights issue. Rights issue price was 27.5 and the last date was 1st of July. Fair value immediately prior to exercise was 143. Now what you have to do? First, calculate theoretical exercise price. This is the first step you should be doing. How to calculate theoretical exercise price? Existing shares 5. Existing shares 5 multiplied by fair value 143 plus 2 multiplied by what is the rights issue? 27.5, very less, divided by 5 plus 2. So this will be 5 multiplied by 143, 715 plus 54, 55 divided by 7. 715 plus 55 is 770. 770 divided by 7 is 110. So this is 110. Okay. Now here what they have done is they have taken total number of shares. Can we take total number of shares and do? Of course you can do. You can take total number of shares and you can do that as well. Okay. So first step is done. Then second adjustment is, or second calculation is the adjustment factor. As I told you, always greater than 1. So fair value divided by theoretical exercise price. What is the fair value? 143. Exercise price 110. 143 divided by 110. 143 divided by 110. You get 1.3. Now, after that is done, we need to calculate basic earning per share for 21-22 and 22-23. For 21-22, what you have to do is, for number of shares, you will take 4 lakhs multiplied by 1.3. To calculate the number of shares for 21-22, you will take 4 lakhs by 1.3. Or what you can do is, for 21-22, EPS original is equal to 39 lakhs divided by 4 lakhs. That is 39 divided by 4, 9.75. This is the originally reported EPS. This 9.75 to restate, what you can do? You can do 9.75 divided by 1.3. So 9.75 divided by 1.3, if I do, I get 7.5. Or what you can do? You can change the number of shares like this, 4 lakhs into 1.3 and do this calculation. So EPS originally reported 9.75, restated EPS 7.5. Now what about 22-23? For 22-23, to calculate weighted average number of equity shares, original equity shares 4 lakhs multiplied by bonus adjustment factor 1.3 multiplied by 3 divided by 12. Why 3 divided by 12? April, May, June. This is one number. Then after the bonus issue, after the rights issue, 4 lakhs plus how many shares? 2 for 5. So new shares is equal to 4 lakhs into 2 divided by 5. That is 5 8s are 40. You get 1,60,000. This 1,60,000 is 1,60,000 plus 4 lakhs. 5,60,000 is outstanding for 9 out of 12 months. So 4 lakh into 1.3 into 3 divided by 12, that is 4 lakhs into 1.3 into 3 divided by 3, 4, 4, 1. 1 lakh into 1.3, 1,30,000. Then 5,60,000 into 9 by 12. So this is 3, 4, 560 into 9 by 12. $4,20,000. This will make it 5,50,000. So EPS will be 59,40,000 divided by 5,50,000. The number that you get here is 10.8. Okay. So to recap the steps: first, calculate theoretical X rights price, that is existing number multiplied by fair value or market value plus new multiplied by rights price divided by existing plus new. Second, right adjustment factor is equal to fair value divided by theoretical X rights price. Then third, weighted average number of equity shares is equal to first existing number of shares multiplied by right adjustment factor multiplied by, let us say, 3 by 12 in our case. It could be 5 by 12, 4 by 12, whatever it is. Then existing plus new multiplied by 9 by 12. For previous year, divide reported EPS by right adjustment factor or decompute. Are we clear with this? Any doubt in the calculation of theoretical X right price, right adjustment factor, and how to handle the question? Never mind, sir, I made a mistake. It's okay. See, even I did an error in calculation, right? First time. It happens. The idea is not to make these mistakes in the examination. Simple calculation mistakes, simple counting of month mistakes. Such things we should not do. Okay. You see, if the question itself is very, very different, very, very difficult, we can't do much about it. But these type of questions, if there is, what I'm trying to tell you here is, if there is a question on rights issue, you should be happy that you will be able to score 5 out of 5 in that. That is our idea. Okay, right from day one, we have been focusing towards this to ensure that we get 60 marks in advanced accounting at least. Anything above that will be a bonus for you. Okay. See again, November 19, 5 marks. Same question. Rights issue, prior 50 lakhs, current year 75 lakhs. So calculate theoretical X right price, originally reported, restated, and the new weighted average. Okay, done. Now, the next thing that we need to understand, and that is the only difficult part here is diluted earnings per share. Now I want you to understand the logic why it is diluted, when it is not diluted, and then we'll do. What is diluted earnings per share? Basically, diluted earnings per share is when there are new shareholders who can come. Okay, I'll give an example for this. Let us say 4 friends are partying. You are partying. For the party, you have purchased 1 liter of drinks. Okay, you have purchased 1 liter of drinks. Now, if 4 of you are there, each one gets 1000 ml divided by 4, which is 250 ml. Okay, each one of you will get 250 ml. Now, say for a moment, one more of your friend who was not certain who may come, who may not come, he comes or he may come. Okay, if one of your friend comes, now you have 5 friends. What happens is you get 1000 now by 5, 200 only. Earlier you are getting 250, now you are getting 200. Your number has come down. This is called dilution. But say for example, this new friend who came, that one friend who came, he got 500 ml bottle with him. Then what happens? 1500 divided by 5, each one of you get 300. Here your share has increased. So when your share has increased, it becomes anti-dilutive. When your share has decreased, it becomes dilutive. When your share has increased, it becomes anti-dilutive. When your share has increased, it is anti-dilutive. When your share has decreased, it becomes dilutive. Okay, this is the concept of dilution of share. Now, these are day-to-day life. In real life, what happens is there are something called as potential equity shares. There are potential equity shares. So what are these potential equity shares? These are the shares which can become equity shares in future. Which can become equity shares in future. Now, the investors, they want to know that if these shares become equity shares in the future, what will happen to my earnings? Like in your case, when your friend came, what happened? When your friend came, your share reduced. Like this, the equity shares want to know if there are convertible preference shares or convertible debentures. If at all they come, what will happen to my earnings per share? That is what they want to know, and for that purpose we have to calculate diluted earnings per share. Now the way it works is, let us say earnings available to equity shareholder is 1 lakh. There are 10% convertible preference share. This is worth 1 lakh of face value 10. Okay. Now 1 lakh number of preference, value of preference shares. 10% is the dividend. Face value is 10. And let us say number of equity shares is 2 lakhs. Number of equity shares is 2 lakhs. Now, what is my basic EPS? My basic EPS is 1 lakh divided by 2 lakhs, that is 0.5. Now, assuming these preference shareholders, they get converted to equity shares, what will happen? Sir, what is the conversion ratio? Assume 1:1. Assume 1:1. How many shares are here? We have 1 lakh divided by 10, 10,000 shares are here. We have 10,000 shares. So, if they are converted, what happens is, earnings available to equity shareholders will become, see right now we have 1 lakh as the earnings. If they convert, we don't need to pay them dividend. While calculating this earnings available to equity shareholders, we had reduced preference dividend. Now we don't need to pay that dividend anymore. That is our savings. So our earnings will be 1 lakh plus 10,000 of preference dividend that has been saved, divided by, what are the number of shares? 2 lakhs, plus we'll get 10,000 more shares. Now this will be 1 lakh 10,000 divided by 2 lakh 10,000. So if you do the calculation, one lakh 10,000 divided by 2 lakh 10,000, it is 0.52. Oh, so when the preference shares got converted, earnings per share actually increased. So this is called anti-dilutive. So what could be the scenario when it is dilutive? Assume for a moment earnings available to equity shareholder was not 1 lakh, but it was 3 lakhs. So basic EPS is equal to 3 lakhs divided by 2 lakhs. This is 1.5. Now, after conversion, earnings available to equity shareholder is equal to 3 lakhs, our basic earnings, plus 10,000 of dividend saved, divided by 2 lakhs 10,000. This is 310 divided by 210, it is 1.47. Now what happened? Earlier it was 1.5, now it has come down to 1.47. This is called diluted EPS. Please remember, diluted EPS is reported. It is reported only when the earnings per share actually reduce. If the earnings per share actually increase, it is not called dilutive, it is called anti-dilutive or non-dilutive, right? So that is the first thing. Second scenario happens when there are convertible debentures. Now let us say we have 10% debentures of 1 lakh. Okay. Interest is 1 lakh into 10%. 10,000 of interest is payable. 10,000 of interest is payable. Right. Now when 10,000 of interest is payable, if these debentures get converted, I will save interest. When the debentures get converted, I will save interest. But the moment I save interest, I have to pay tax on that. Because when I save interest, my income becomes higher, I have to pay tax on that. What is the tax? Assume tax at 30%, tax is 3,000. So 10,000 of savings, 3,000 of tax, net savings is only 7,000. So we have to see what is the after tax savings. How to calculate that after tax savings? Interest into 1 minus tax rate. Interest into 1 minus tax rate. So whenever we are calculating diluted earnings per share, you will take earnings available to equity shareholders as per basic earnings per share plus what? Any savings after tax. For preference dividend, tax is not relevant because we don't have any tax payable on preference dividend. Okay. Then sometimes there may be share options. Now whenever there are share options, these share options also create diluted EPS, and here there is no savings. Here there is no savings that you will see. So whenever there are share options, first you will take share options, then in the order of dilution you will consider the remaining options. For example, dividends and your interest. Now how do we do that? How to check order of dilution? First, if there are any options, this is the first thing. It is first thing because in case of options there is no savings, we will give some shares for free, and to that extent it will be diluted. Okay. Then after that, what you do? You compute incremental EPS per share. What do I mean by that? For example, preference dividend or preference shares, not dividend. Preference shares. What is the savings? Savings was 10,000. What are the number of equity shares? 10,000. So savings divided by 10,000. 10,000 divided by 10,000, it is 1. For debentures, savings was 7,000, and assume the number of shares are 1,000. Number of shares means after conversion, how many shares do we have? After conversion, how many shares do we have? So 7,000 divided by 10,000, this is 0.7. This is 0.7. So here incremental EPS is 1, incremental EPS is 0.7. So this becomes dilutive. This is also dilutive, but you will take this as the first preference, this as the second preference. So first you will consider impact of debentures, calculate diluted EPS, then consider preference shares, and then calculate diluted EPS. Okay. Coming back to theory. Coming back to theory, potential equity share is a financial instrument or other contract that entitles or may entitle its holder to equity share. Examples: debentures which can be converted, preference shares which can be converted, share warrants, options including ESOPs, shares issuable on satisfaction of certain conditions from contractual obligation, etc. Okay. Right. Now, for the purpose of calculating diluted EPS, the amount of net profit or loss for the period attributable to equity shareholders is adjusted by following after tax: dividends on potential equity shares which have been deducted in arriving at earnings available to equity shareholders, interest recognized in the period for dilutive potential shares, any other changes in income and expense. Generally, we get only the first two ones in the examination. For calculating diluted EPS, varied number of equity shares outstanding and weighted number of equity shares which would be issued on conversion of all the dilutive potential equity shares are used in the denominator. Now the question is, from which period or when do we say, or at what time have we issued those shares? So for conversions, it is deemed that they have been converted at the beginning of the period or the date of issue if it is later. Meaning to say, if this is 1st of April, this is 31st of March, they were issued here. Issued in the previous period, you will consider 1st of April as the relevant date. If it is issued during that period, you will consider from this date. Okay. Now, share warrants and options. This is one more calculation that we have to be aware of. So share warrant and options, they are dilutive when they would result in the issue of equity shares for less than fair value. How to calculate? Very simple. Let us say I have given 1000 ESOPs, share options, which can be exercised at 100 per share. Which can be exercised at 100 per share. 1000 ESOPs can be exercised at 100 per share. Fair market value of this is, say for example, 120. Fair market value is 120. How many have I given? 1000. At what value? 100. So, amount collected is equal to 1 lakh. Number of shares at fair value is 1 lakh divided by 120. 1 lakh divided by 120 is 12 8 is 96, 85, 850. I'll cross check. I have been making this silly error. 1 lakh divided by 120. See, again made a mistake. Not 850. It is 833. 833.33. So, what we are saying is, whatever amount the shareholders have given us, how many full value shares can be issued? How many full value shares can be issued? We can issue 833.33 full value shares. Full value shares. Which means, out of 1000, 833.33 is full value shares and 167.67 are free shares. 1000 minus 833, 167.67 are free shares. So, for options and warrant, what you will do is, these free shares, you will directly add to the denominator. Free shares, you will directly add to the denominator. Okay, that is one treatment that you have to remember. Okay, so now, we can directly jump into the question to calculate 2 or 3 varieties of diluted earnings per share. On 1st of April, ABC has given the following information: 50,000 equity shares of 100 each, 80 paid up by all shareholders, 40 lakhs. 2 lakhs 8% preference shares of 10 each, 20 lakhs. 10,000 12% of debentures of 100 each, 10 lakhs. This is the value of these. Okay. Each debenture is converted into 3 equity shares of rupees 100 each. Preference shares, they have not told anything, so we'll assume those are non-convertible. On 1st of July, the remaining 20 was called up and paid up by all the shareholders except one shareholder holding 10,000 equity shares. During the year, the company had a profit after tax of 344, tax rate is 30, calculate basic and diluted. Slightly long question, given 5 marks, but we can score 5 out of 5. First, basic. For calculation of basic, what do we need? We need weighted average number of equity shares outstanding and earnings available to equity shareholder. Now, what they have told us? The company had a profit after tax of 3,44,000. Now, for preference shares, have they told whether it is cumulative or non-cumulative? They have not told us. Had they told it is cumulative, we would have considered cumulative and done the treatment. Because they have not said whether it is cumulative or not, we will not consider. Okay. So, for basic, it is very simple. We have to calculate weighted average number of equity shares. How to calculate? First, on 1st of April, 50,000 shares are outstanding, 80 paid. So, and the call happened on 1st of July. So, April, May, June, 3 months. So, when you calculate, 1st of April of 23, 50,000, amount paid is 80. So, what we will do? 50,000 into 80 by 100 into 80 by 100. Why 80 by 100? 80 is paid up into 3 by 12, 10,000 first. Then on 1st of July, 40,000 paid, 100 fully, because 80 was already paid, 20 has been paid. So 40 into 100 by 100, so basically 40,000 into 9 by 12, 30,000. And on 1st of July 23, these 10,000 shares, they are paid us only 80. For the remaining 9 months, it is 6,000. Total becomes 46,000. The other way, what I told was, you consider 40,000 is 80 paid up for 3 months. Then 40,000 is 100 paid up for 9 months. Then 10,000 is only 80 paid up for full 12 months. So this also can be done. Okay, right? We got 46,000. So for basic earnings per share, net profit attributable to equity shareholders, so this is, I think, a printing error in this question itself. It is not 344. Net profit is 344. Okay, we'll do considering 344, right? There is some error in calculation here. 344, I'll get it cross checked, divided by 46,000. That is 344, 123 divided by 46,000. We get 7.47. We get 7.47. Or if you say that this profit is before interest, before tax, then that's a different question. Then we have to do the actual calculation. Okay, that is the first. Then second is for diluted EPS. Now for diluted EPS, what do we do? Okay, so here they have assumed preference shares are cumulative. If you assume preference shares are cumulative, then it is 344 minus 160 divided by 1,84,000. Now I don't think there is any ground to consider that the preference shares are cumulative. I'll cross check this question with the actual question in the exam. Okay, but I don't see that, this has been, there is no dividend declared. They have not mentioned it is cumulative. So generally it is considered to be non-cumulative if nothing has been mentioned. If it is cumulative, they have to mention it is cumulative preference shares. So what happens if we write, if you do this in the exam, you will get the marks, provided you write the assumptions clearly that the preference shares have been considered to be non-cumulative. If you consider preference shares are cumulative, 3,44,000 minus dividend, you get 1,84,000, and accordingly the EPS becomes 4 per share. And if you have time, you can do that, both the workings also. Okay, be prepared for questions having incomplete information where you have to make an assumption. For example, recently in AFM paper, what happened was they did not give the discount rate. 8 marks question, I think. 8 marks question, discount rate was not given, and you can solve only half the question without the discount rate. So what do we do in that situation? Assume discount rate is, let us say, 10% and solve the question. You may also get, I think in September paper, the costing question had some ambiguity. Okay, there also what you have to do, you have to assume and you have to do it. Okay, then for diluted EPS, what we'll do is we take earnings available to equity shareholders plus interest savings. Now what is interest savings? 12% debentures of 100 each, 10,000, 10 lakhs into 12% is my interest. So my interest is 1,20,000, but I have to take after tax. So savings will be 12 lakhs multiplied by 1 minus 30%, 0.7. So not 12 lakh, 1,20,000. 1,20,000 into 0.7, my savings will be 1,20,000 into 0.7, savings will be 84,000. So if I take 184 plus 84,000, I get 268. If I take 344, where was that? If I take 344, assuming preference shares are non-cumulative, then I will do 344 plus your 84. Okay. Then how many shares? 3 shares you can convert. So you have 10,000 debentures, 3 shares when you convert, you get 30,000 shares. So in the denominator, you will take 46,000 plus 30,000, 76,000, and then you will calculate the EPS, which is 3.53, or if you take 344, the pencil got disconnected. I'll just explain it orally, and then I'll charge the pencil and we'll continue. Or you will take 344 or you will take 344 plus 84 divided by 76 and you will do. Now, sometimes what happens is, here you got 4. The EPS what they have calculated is 4, and here you got 3.53, it is dilutive. Sometimes if this number becomes bigger, you will say the convertible or the potential equity shares are non-dilutive, and hence diluted earnings per share is not to be reported. You have to make this statement, only then you will get the marks. Okay. Then number 22, 5 marks. Following information is provided to you. Net profit for the year 72 lakhs, weighted average number of shares outstanding 30 lakhs, average fair value of one equity shares 25, weighted average number of shares under option during the year 6 lakh shares. So this is about option. Exercise price for shares under option is 20. You are required to compute the basic and diluted. Now basic earnings per share is basically your net profit divided by weighted average number of shares. 72 divided by 30, 2.4. No problem there. However, diluted EPS, as far as diluted EPS, for options, what you have to calculate? Free shares. You have to calculate free shares. How to calculate free shares? First, number of shares under option, 6 lakhs. So you have to see what is the amount you will collect from here. 6 lakhs multiplied by 20, you will collect 6 lakhs multiplied by 20, you will collect 6 into 20, 6 into 12, 0, 0, 0, 0, and one more 0. Okay. One more 0. Okay. Amount. Number of shares at fair value is equal to 1.2 crores divided by, what is the fair value? Fair value is 25. So 25. Okay. 1/2 divided by 25, if I do, I get 4,80,000. This is the full value shares. This is the total number of shares. So dilutive shares is equal to 6 lakhs minus 4,80,000, that is 1,20,000. So dilutive shares are 1,20,000. Again, I am repeating how to calculate. Take the total proceeds divided by fair value, that is the full value shares issued. Remaining shares we will assume is dilutive. Right. Now, to calculate diluted earnings per share in case of option, there is no adjustment required in earnings available to equity shareholders. There is no adjustment required in earnings available to equity shareholders. Whatever adjustment has to be done in the denominator only. What is to be adjusted? Take the weighted average number of shares as per basic earnings per share plus 1,20,000. You get 31,20,000. Okay, 31,20,000. So diluted EPS is 72 divided by 31.2, 2.31. Always remember, options are dilutive. Options are dilutive if they are issued at less than the fair market value. Okay. Any doubt in options calculation? This is important. Any doubt? Okay. This one. A listed entity on 1st of April had the following capital structure. See, for listed entity, actually Ind AS is applicable. Okay, but anyways, we'll have to do as they have given the question. Okay. 10 lakh equity shares having face value of 1 each, 10 lakhs. This is the number. 10 lakh 8% preference shares having face value of 10 each, 1 crore. During the year, company had profit after tax of 90 lakhs. On 1st January, NAT made a bonus issue of 1 equity share for every 2 equity shares outstanding as of 31st December. On 1st January, they issued 2 lakh equity shares of 1 each at their full market price of 7.6. NAT shares were trading at 8.05 on 31st of March. Further, it has been provided that basic earnings per share for the year ended 31st March was previously reported as 62.3. That is previous period. You are required to calculate basic earnings per share to be reported in the financial statement before the year ended, including the comparative figure in accordance with AS 20. Explain why the bonus issue of shares and the shares issue at full market price are treated differently in the calculation of basic earnings per share. Now here, this part is straightforward. This is where they have asked more, technical part. Why should we do it? Now, first thing, why we should do it is, in case of bonus issue, shares are issued to existing shareholders for no additional consideration. Therefore, the number of equity shares outstanding is increased without an increase in the resources. Since the bonus issue is an issue without consideration, issue is treated as if it had occurred prior to the beginning of the period. Now, when I am issuing bonus shares, I am not getting any additional resources. Because I am not getting any additional resources, the earnings will not have a change. And when I am reporting, I have to report as if I have received those shares or those shares have existed from the beginning of the period, because there is no change in the capital that I have invested. There is no change in the capital that I have invested. So, if I have not invested anything new, my earnings will not change. So, if I provide it comparatively only for the current period, it will not give a true picture. So that is why we restate from the beginning of the previous period reported. Whereas share issued at full market price does not have any bonus element and results in proportionate change in resources available. Means if I get money, my earnings will also increase. If I get money, my earnings will also increase, and hence I will not treat it as the same as the bonus element. Okay. Then how to calculate adjusted EPS? Now for adjusted EPS, what you have to do is, for the previous period, what are the total earnings divided by existing shares plus bonus issue. Existing shares plus bonus issue. Okay, so even in this question, they have taken these preference shares as cumulative. So I think I have to change my statement slightly. If nothing has been given, consider them to be cumulative. This is not the right approach, by the way. Though they have said it is non-cumulative, though they have not mentioned anything, assume it is cumulative and solve the question, so that there is no confusion in the examination. December 21, 5 marks. Net profit for after tax 64,12,500. Number of equity shares outstanding 15 lakhs. Number of 9% convertible debentures of 100 issued on 1st of July 75,000. Now, if you have issued on 1st of July, factor has to be considered from 1st of July only. Each debenture is convertible into 8 equity shares. Tax relating to interest expenses 35%. You are required to calculate diluted EPS. Now, for diluted EPS, you will take earnings, then you will adjust the interest. Interest is how much? 9% into 100 into 75,000. 75,000 into 9% into 100 into 1 minus 35%. Basically, that is how you will do the calculation. So, 75,000 is the total number of shares multiplied by 100, sorry, total number of debentures, 100 into 9%, that is 6,75,000, right, into 65%, we get 438 Oh, again, see, I missed this. 1st of July. So I'll do it again here. Interest savings is equal to 75,000 multiplied by 100 multiplied by 9% into 9 divided by 12. See, you have to be, I tell you and I only miss the date. 1st of July 2020, so 9 months. Okay, so the into 1 minus 35%. So this will be into 9 divided by 12, 3,29,062. Okay, so adjusted profit will be 64,12,500 plus 3,29,062, which is plus 64,12,500, which is 67,41,562. Right, this is the earnings. Now in weighted average number of equity shares also, what you have to do is you have to take 15 lakhs for full period plus how many debentures? Each debenture is convertible into 8 equity shares. 75,000 multiplied by 8, that is 6 lakhs. Okay, plus 6 lakhs. This also into 9 by 12. This we will not take it from the beginning of the reporting period. This we will take only from the date of issue. But if this was 1st of July of 19, then we would have taken from the beginning of the previous period. Okay, so number of equity shares is 15 plus 6 lakhs into 9 by 12, that works out to 19,50,000. Diluted EPS is 67,41,562 divided by 1950, 3.46. Basic EPS was how much? Basic EPS is 64,12,500 divided by 15 lakhs, 4.28. Now 4.28, and this is a reduction to 3.46. It is considered to be diluted. Sir, there was sufficient profit for preference dividend, so maybe they have assumed to be declared. See, practically it doesn't happen. Okay, so for example, I'll tell you. Of course, one is what you write in the exam. Second is what you learn for real life. For exam, you can assume that, but like for example, we have issued compulsorily convertible preference shares. Compulsorily convertible preference shares. Okay. Now, I cannot say that this is a cumulative preference share. I have to specify that this is cumulative. Otherwise, how will I know whether it is cumulative or not cumulative? Anyways, by looking at the past two questions, we can assume that it is cumulative and accordingly solve the question. Because think of it, no? If I am not declaring dividend and it is a non-cumulative preference share, then there is no liability on my side to pay the preference shareholders. So that is the logic. This you can do it. This is again basic and diluted EPS on your own. This you can have a recap at it. Again, rights are standard. The rights issue are standard. So you can okay. Presentation. Basic and diluted EPS should be presented on the face of statement of P&L for each class of equity shares with equal prominence. So you have to disclose basic and diluted EPS, and also you have to compute it excluding extraordinary items and considering extraordinary items. This will not be tested. This is only for your remembering. What's the time? We are already at 11:40. So again, we'll pause here. Just wanted to check with each one of you. Can we extend the class timing by another half an hour so that we can complete it faster? See, there are other students who have taken, but they are watching on a recorded basis. You 4-5 of you are, Preeti I think joined today only. Others, Shamla and Ram, if you can confirm, so that we'll try to extend it because what is happening is one chapter I'm not able to see, 1.5 hours it took, right? In 20 minutes it will be a break again. So I want to extend it so that at least we can cover 2 chapters comprehensively, and now we'll be moving to the longer chapters of cash flow statements, financial statements, and all of that. There also we need to spend slightly more time. Okay, right? So we will extend. Tomorrow we don't have a class. ICI election, so have to go out and vote and all of that. Monday onwards, we'll do 10 o'clock to 12:30. Okay? Sure. Thanks a lot. Hello students, I am CA Suraj and I have some amazing news for you. We have started a live fast track batch for advanced accounting with a target of scoring 60 plus in the examination, and we'll be conducting these classes on live basis, so it will be live class through Zoom. We've already started the session, and if you want you can still join in now. All the recorded sessions or all the completed sessions are available as a backup. The focus will be covering the complete syllabus, all the concepts of the entire syllabus in the live class in a quick manner so that you have comprehensive understanding, followed by some very important questions from study material, past exam papers and RTP. So the idea is to make you exam ready, so that without any problem you can score 60 plus. And I'll also give you tips how to maximize scores in these bigger chapters or bigger questions like financial statement, internal reconstruction, amalgamation and consolidated financial statements. In all of these chapters, there are few things which you need to keep in mind so that you get high marks in these particular questions. A lot of time what students do is, because they find a difficult question in consolidation, they will leave it. We should not make that mistake. Out of 14 marks, there are very easy ways to score at least 6 to 8 marks, even if you are not able to solve the full question. How to do that? I will be teaching that to you in the class and giving you how to handle MCQ in the examination, some tips to save time, some tricks to find out the answers very quickly. If you are looking for a fast track batch, I suggest you to have a look at the demo lectures which is given in the comment section. Have a look at it, and if you like the classes, do enroll for the classes. It'll be very helpful for you to prepare for your upcoming examination.